All right, good Thursday afternoon, investors and traders, our Finom Group members, and our YouTube audience. This is Finom Group's weekly State of the Market. I am your host, as usual, Seth Golden, and joined with me again this week is my good friend and investor, Brad Carter. Welcome, Brad. Thank you for joining me again. It's always good to have another opinion and feedback from somebody else while we're doing the State of the Market. So thank you again, sir.
How Glad to be here again.
Thank you. How are we doing this week in the Brad Carter portfolio, given yesterday's price action after Jerome Powell's speech?
That was crazy. I told my wife, I said, I don't think I've ever sold so many positions within a half hour or something. It was like, okay, what else have I got to look at? But because over the last 2 years, I have really expanded my portfolio to where it's starting to look like a mutual fund.
Okay.
And when you have 30, 40 positions and you get action like that, there's a lot of management to do.
Yeah. I try to keep my portfolio more slimmed down, and I do a lot of index ETF investing. I don't have to manage so many positions, and I don't have to do research on 20, 30 companies, just because I've always, if I'm going to invest in a particular stock, a particular company, I want to be able to dedicate time to looking at their quarterly filings and doing spreadsheets so far as their trending metrics. And I used to have 20, 25 positions at any one given time. And you just realize over the years that there's not enough time for yourself to do all that due diligence. So as I've gotten older and as I've gotten more experience, I realize the value of index investing, as well as just dollar cost averaging during market declines, and rebalancing on a quarterly basis. But I was in the same camp. That doesn't mean I wasn't in the same camp as you yesterday, which is, and I'm glad you spoke to your activity yesterday in that respect, because we've been dip buyers all year, and a smart dip buyer is going to be selling the rips when you're still technically in a downtrend or in a bear market. I mean, that's your opportunity. You get a big up day like we did yesterday, and you start looking at the stuff that you bought the dip on, and if it's hitting your profit objectives and what have you. So I was doing the same thing. I sold some of my outstanding JP Morgan, some healthcare ETF, the XLV, which I think we were positioning in the low 131s, and it was all the way up to 138, almost 139 yesterday. So I was taking some profits there. Oh gosh, what else? Starbucks. We have an investing position in Starbucks that we started basically our dollar cost average. We started just a quarter ago, maybe 3-4 months ago, and in the $78 range. And today it's $102. So actually, we took some of that off the table here today. But that's been, that's still an investment that we want to hold into the next year. But from $78 to $102, what does Jim Cramer say? You got to ring the register, with some of that. Let the rest run, and maybe even if you get a pullback, you can reload, if you will. So good stuff. Buy the dips.
And I had some after hours action I didn't expect. I didn't know report. I had forgotten to look for that, and I saw the stock was just going really getting dumped after hours. So I went and looked. Just read the headline and kind of what the numbers were.
Which stock was that again?
Huh?
Which stock was that? Snow, okay.
Snow, SNOW. And they sold off hard, just like they did after their last report. And
I thought that was up in the pre-market today, though, right?
It was up last night. As soon as I saw it fell all the way down to 125 from 150 or something like that, I think. And I said, BS. I said, there's nothing wrong with the report. They were soft on guidance, like everybody's being right now. So I bought the dip, and it immediately just went up and made up all the loss. And today it's ahead of where it was
Right.
before they reported.
All right.
It's a good little company. There's
So
nothing
yeah,
wrong.
no, I see. I'm looking at our Telegram app for Finom Group right now, and I see your snow got clobbered on a beat. Must have been guidance. Bought snow 125.08 in after hours. I see it right here. So yeah,
Yeah.
you did very well on that, sir.
And I think it's in the 150s right now. Yeah.
Yeah, very nice, very nice. All right,
And
so well,
so,
speaking of what you did there, this is a quote from Warren Buffett as we start to dive into our state of the market content here. Opportunities come very infrequently. And that snow was a pretty big opportunity. I actually think that what's happening today in Costco is another related opportunity. But as Warren Buffett says, opportunities come infrequently. When it rains gold, put out the bucket, not the
yeah,
thimble. You want to capture as much of that opportunity as you possibly can.
yeah,
So good on you. You pulled a Buffett yesterday, sir, in the after hours. Nothing wrong with pulling Buffets, that's for sure. Here's something I've been talking about, with our members and in our trading room throughout the course of the week, and just as a best practice as an investor, you want to have a process that includes best practices for investing. And this is my mindset basically, because the absolute best investors I've encountered aren't successful because they predicted the trend or the macro outlook, but because they have a time-tested process that doesn't rely on such predictions. In other words, we know ultimately the market's going to go higher over time. We don't have to really predict that. That's inevitable. So as long as we have a process that allows us to take advantage of, when the market's raining gold, so to speak, where we can put out that bucket and collect some of that value, we'll do well over time. We don't need to predict where the market's going to be next week, next month, next quarter. We just need to know how to manage cash so that we can put out that bucket when it starts raining gold and capture all that value. So we've been talking about buying value ever since the June lows, quite frankly. And in this right here, I don't know if you remember, Brad, but this was from our June 26th research report, which I pulled up here. Just so everybody knows, I'm not pulling this out of my arse, if you will. But this is the reality. This was in our June 26th report. June 26th, our research report to Finom Group members. And I don't recommend stocks or ETFs in our service, but I do inform as to what I'm doing and what I think looks like good potential value for investors. And these were the stocks that I had suggested, in that June 26th report, kind of in conclusion, if you will, all the way at the bottom. How much detail do I put into these things? But here were the stocks. And I kind of just wanted to see where we were from June 26th when we listed these to today. And so Disney was trading $97 then. It's $98 today. Not that great, right? PayPal, $77 on that day, $77 today. Two that basically have gone nowhere. Now, Disney's been as high as 120 and PayPal's been as high as 102. So a lot of volatility there, obviously. Boeing's been good to us, though. Boeing, $141 back in June, $178 as of yesterday's close. Amazon, that was the one loser that we got on the board here. 116 back in June, now $96. JP Morgan, 117 back in June, 138. And the good thing about JP Morgan is if you bought back then, you also got $1 per share dividend. So that helps as well. But that is a substantial gain right there. 117, that's a 20% gain basically. TJ Maxx was a big gainer, $60 to $80. You also had a 50-cent dividend per share on that one. Starbucks, we've already talked about. We were, basically we had an official position for our members, $78, and as of today at the open, $102 plus the dividend. So just kind of keeping ourselves honest. They're not all going to be winners, but as long as you have winners that can offset your losers, you're going to do very well over time, and you get some income with dividends. And these were the 7. To my point earlier, I could have listed 30 stocks that I thought were looking good back then. Again, that's a lot to manage. That's a lot of earnings calls. That's a lot of headlines to watch. And so these at the time, and these are blue chip names, we know these are, companies that may have fallen on hard times, but they're not down and out. They're just down. And when they're down, but the fundamentals, are going to be revived over time, that's where value is understood. So I think we did a good service to all of our members by offering these suggestions, if you will. Moving on, a lot of what we talked about this year is because we are in a midterm year. We've gotten past midterm elections, and lo and behold, the market is up since those midterm elections. But the tightest analog that we have on record for 2022 is still 1962. Back here a few weeks ago, it had an 88% correlation with the price action in 2022. That's almost perfect. And as of yesterday, here's a better chart with the most recent move in the market. I mean, to a T. This chart is from Ryan Dietrich at Carson Wealth Group. They know what we've been watching for quite some time. We're not the only ones that follow analogs to see how effective they are, and to see if, price action repeats, if not very closely rhymes to history. And so far, 1962 it's repeating almost textbook. This year, bad year for everybody. The Fed is hiking rates, but this is the absolute worst performance going all the way back to 1973. S&P 500 returns during extended Fed hiking cycles, as of a couple of days ago, down 16%. So just the absolute worst. And there's basically not been any place that you could hide confidently this year. We always follow breadth. We follow the technicals, the quantitative data, the fundamental data. And what we've been monitoring for the last couple of weeks during this rally is breadth supporting the rally, or is it just a handful of names? And the reality is, indeed, the interim breadth continued to strengthen alongside the long-term breadth. And the way that we decipher that is looking at the percentage of S&P 500 stocks trading above their 50-day moving average. Now, a key threshold, or kind of a breadth achievement of consequence. And what do I mean by that? Well, consequence means that we can kind of project forward. Based on a certain threshold, when you reach that threshold, there's a kind of a predictable 12-month return positivity rate we can define. And for the S&P 500, one of those breadth thresholds is 90% of stocks trading above their 50-day moving average. And as we can see here, as of yesterday's close, 92.6%, which is actually a little bit better than during the June to August rally. We just got above 90%. And then we consolidated the vast majority of that, but off to the races again. I mean, what are the odds? What are the odds that, first of all, this has never happened twice in the same year, where the percentage of stocks trading above their 50-day moving average, rallied to above 90%, consolidated the majority, and then got back above 90% in the same calendar year. It's never happened before. And people are always saying, don't fight the Fed, don't fight the Fed. And when you see something like this that has never happened before, above 90%, washed out to below 5%, and then back up, who's really fighting the Fed here? Because it seems like stocks want to go up when you see this happen twice. It kind of flips the script when you look under the surface of the market and you see this kind of breadth, and it almost makes you think it's not the longs that are fighting the Fed, it's the shorts, because the breadth is telling you stocks want to go up, Fed tightening be darned. What do you think, Brad?
I was thinking yesterday, and I still think this today, that investors may be becoming more comfortable with where the Fed is. And that's why I told you off air that I thought Powell did such a really good job. Did you notice he touched all those points we've all been talking about?
Yeah.
He acknowledged, if this, then that, on a lot of things. He made it real clear that the last thing he wanted to do was hammer this thing into a recession.
Yeah, he did. I think that was the only difference I was able to pick up on, was that he did mention that's not the objective to drive the market into a recession.
Right. But his tone was more like, I felt like I was in a classroom. In fact, I said, this is the way I would lecture in a classroom talking about all this stuff.
Yeah.
And it just felt more like that than this hammer trying to scare everybody to death.
Right.
And
so not like Jackson Hole. Jackson Hole.
Oh my gosh.
The hammer out for sure.
Well, and hindsight's 2020. There may have been a bit of irrational exuberance at that time. People thinking, okay, we're going to hike real quick, and then we'll be dropping rates again in January. Everything will be good. Yeah. Well, that's not what it's going to be, And now I think as investors, we understand that now, and so the big market movers, if we understand it, they do too.
Yeah.
And so I think even though this is not like 2008, I think the volatility going forward may be a little bit like coming out of 2008. We're going to see fits and starts. Mm-hmm. You're going to see CNBC marching out the bears every day, while the market struggles its way forward. And I'm going to say right now on the record that I think next year's actually going to be pretty good.
Awesome. Well, and I'm glad. Yeah, there's nothing. Nobody can hold it against you. And quite frankly, that was like me stepping out on a limb and saying, I believe, the 2022 lows are in. I said that, about a month and a half ago, thinking that 3,500, based on my projected, ISM Purchasing Manufacturers Index data, as well as just how much we had already derated to 15 times forward earnings, 3,500 seemed like a reasonable low. Even if you don't trust the earnings projections for next year, there are so many other variables that drive primarily it's liquidity and the equity risk premium calculation that is going to drive the market, because that's how people are defining value. But the other thing I've been looking at, religiously, is trying to decipher when that 10-year blinks, because when the 10-year finally blinks, when it achieves its peak and then starts to roll over, it's telling you it's done with the inflation. It's done pricing that in. And I think Jerome Powell yesterday, some of his, conversation and dissemination on inflation was, we're making progress, but we still have a lot more work to do.
Right.
But he also recognized part of that work, and this kind of goes hand in hand with being an investor. Part of that work is doing nothing and just being patient, right? We think that work is, well, we got to execute. We've got to, find the next trade. We got to, sometimes you have to sit on your hands and be patient. And I think that that's hard work for most investors and traders that are actively managing their portfolio. That's hard work, to sit behind the screen, watch the ticks, and do nothing, not execute a trade. So that is hard work. And I think, without saying that, that is also going to be difficult for the Fed, the FOMC committee as a whole, to hit the pause button and watch how things develop after already hiking to what might be 4.5%, 4.75% on the Fed fund rate. So I think the market appreciated that kind of verbiage from Jerome Powell yesterday. And I think it was also confirmed by how the Fed fund futures were being priced. They actually are still pricing, after the whole webcast at the Brookings Institute, they still priced 4.9% on the terminal rate. Well, that was the same terminal rate going back to the November FOMC meeting. So basically, Fed fund futures determined that Jerome Powell was neutral. He was no more hawkish than he had been in the past, and that gave investors a bit of confidence that they're finally right. We've got it. 4.9% is probably the peak. And as
Seth, if we get a 50 in December and say a 25 in January, where would that put us?
Well, 50 would get us to 4.5%. There's no meeting in January, so the next meeting is February.
That's right, February.
And so if that's 25 basis points, we'd be at 4.75. 4.7.
That might be it. That they might actually come up a little short of their projection, but it's gonna be data driven. I'm
of the opinion, based on what we're seeing in the inflation data of late, and we'll get a big inflation data point tomorrow, the wage inflation data within the non-farm payrolls. But so far, CPI, PPI, and today's PCE inflation data are all showing that they actually should maintain the trend of disinflationary prints. And if that's going to be the case, this December and we'll know because the day before the December FOMC meeting, we get the next CPI. So we'll know, I think for sure, if that comes in the way I think it's going to, this is going to be the last rate hike, in my opinion, taking us to 4.5%. And then, by February, we'll still have another CPI reading, and that should actually start showing some of the shelter and rental components of CPI, which still weigh 32% of CPI, and with energy prices being as low as they've been, I think the disinflation is going to be so strong that there's just no reason to do anything but not hike, officially message that they're pausing, come that February meeting. And, there's two things that drive market liquidity. One is disinflation, or inflation coming down. So it has a big liquidity impulse, if you will. And the other is just going to be financial conditions easing, Fed hitting that pause button, and you're going to start seeing credit conditions, if you will, loosen or relax. Banks start lending more, and you're going to start getting that boost in the money stock or money supply. And that's what drives markets. Number one, that is what drives market performance, liquidity. Number two, we like to think is earnings, but it's a chain of events. You have more money stock, so more money's flowing through the economy. You tend to have a better economy. You tend to have better earnings. So it all comes down to that pivot in liquidity, because this is the worst year, almost the worst year on record, or the worst year going back to 1980 when it comes to liquidity or money stock. We're negative 6% year over year. negative 6% year over year. The only year that was worse was 1980. So it's worse than the great financial crisis when it comes to liquidity. It was worse than the 1970s inflation cycle. And this is one of the things that I've been harping on as well, because we're hearing about the recession, or economic recession and earnings recession. Folks, two things move the market. It's always been this way. Why? Because investors are willing to wait for earnings to come around. They're willing to. It's intrinsic to investing. You know earnings are going to grow over time, so you're willing to wait. That's not going to be what drives the overall market, because investor dollars are willing to wait. What drives the overall market is liquidity, which is a synonym for what's the inflation cycle like, or war. When you have those two, you tend to have the same, they feed off of each other. Inflation tends to go up during, wartime. We had the oil embargo. What was that? 1973 or something like that.
Yeah, about 73, 74-ish, right? Yeah, 73, I think is right.
Yeah, two of the worst years in the market, 73 and 74, two of the worst years. So I guess, if I'm to bottom line this discussion here, I would say investors need to pay less attention. Don't get me wrong. I'm not saying don't pay any attention. You got to have an understanding of the macro fundamental and economic backdrop, but pay less attention to the hyperbole that you're going to hear in the financial media as economic conditions may worsen. But take for example, China in November. The Hang Seng was up 27% in November. 27%. What were the headlines over the course of November this year? Right? Was there any positive headline whatsoever coming out of China? No. And yet the market went up Hang Seng went up 27%. There's a perfect example. And as you were alluding to, you said yourself, you're going to hear CNBC and they're going to march out the bears and everything. But usually the market has already priced that in, and it's looking at the return of liquidity, and it's going to start pricing in a recovery. We don't know exactly when that's going to start, but as long as you have cash on the sidelines, you don't really have to worry about that. Just take advantage of value, because I'm in the same camp. I think it gets a little bit worse before it gets better. I think that's actually becoming the consensus view. Morgan Stanley, JP Morgan, Marko Kolanovic just yesterday issued his note saying, we think that things are going to fall, and we could retest the lows in the first quarter of 2023, because that's generally when we're going to get the fourth quarter earnings and guidance for the full year 2023. And
I'll say this, Seth, if we retest it all, it's got to be early.
Yes.
Because after that, we will have gotten the worst of the sagging earnings out of the way.
I totally agree.
So I would just say, peel off some money in late December, stock up on cash a little bit. Don't get out. Just, raise your cash a little bit. Keep taking your shots here and there. But go into January a little defensive. It's not a bad idea. But this idea of recession to me, Seth, more and more is starting to sound like nonsense.
Yeah, everybody sees it coming. Everybody's in the same boat, right? Everybody knows.
Here's what I think is really going on. We're in a bit of and I'd say a pretty mild one, earnings recession.
Mm-hmm. Yeah.
Not an economic recession.
Right.
People are spending money. I think
it'll be a situation.
I don't think there's going to be a recession next year unless something else happens.
Yeah, I think it's going to be possibly a nominal GDP recession, but not a real GDP recession, because as you said, people are still spending money. People still have jobs. we still have 10 plus million job openings. And I know that the pushback is going to be, yeah, but we're going to start seeing job declines and we're going to see fewer job openings. Folks, the JOLTS record, which was at record levels before COVID, was 7 million. We are still at 10 plus million now. It takes 3 million fewer job openings just to get back to the pre-COVID level.
Mm-hmm.
So there could be that give and take in the labor market, but there's so much slack. There's so much cushion there. Should we come under more, labor market pressure where things actually loosen up, which would actually be a good thing, because you probably get wage disinflation alongside price disinflation. But yeah, there's just so much cushion there. And that's without even talking about the household balance sheet. This is one of my favorite, economic metrics that gives us a good purview into, just the health of the household balance sheet. Household debt service payments as a percent of disposable income. And again, I mean, this was COVID, obviously, but we're still at, this goes all the way back to 1980. Yeah, 1980. I mean, we've never been lower. It's just, and it happened all after the great financial crisis. This was when, households caught religion. They realized, oh, by the way, I do have to be able to pay my monthly credit card bill or my monthly mortgage or my monthly whatever. And they did. They deleveraged and they got, more discipline with respect to, I earn this much, this is my monthly paycheck, and these are my monthly expenses. And yet I still have a pretty good, amount of disposable income. I mean, that's why we had basically the longest expansion cycle in history, because the average household became that much more responsible. And we have that much more cushion going into 2023, still below pre-COVID levels on this particular, what I call, the economic spending impulse right here. This tells you, you lose jobs, okay, but it doesn't equate to a credit crisis. This, you lose jobs, you get a credit crisis. Even back here during the dot-com period, where people continue to leverage higher, and you get the bust. We just don't have excess at the household level, this cycle, and we haven't had it since the great financial crisis. So those things, I agree. It's, it'll be the weirdest in history. If we do have a recession, it'll be the weirdest one in history.
Well, it's already been about the weirdest stock market year in history. So why not?
True. So going back to 50% of stocks trading, 90% of stocks trading above their 50-day moving average. Like I said, we've done it twice now this year. This is the only time in history going back to 1942 that it's happened twice. Because as you can see, every year only happened once. The key here is that 6 months later, this is the 6-month forward return column here. You can see the market was only down once after that kind of breath signal. It was never down a year later. And this was the signal from August. Mid-August, 90% of stocks above the 50-day moving average. And now here we are again, 92+% of stocks above the 50-day moving average. And so that happened yesterday. We closed yesterday at 40.80. We closed yesterday at 40.80, based on the fact that it has 100% of the time been up 12 months later. There's no negative. So, historically speaking, we should be higher than 40.80 by November 30th of 2023. And more than likely, mid-year next year, we should be higher too. Only once in 1947 did you have a negative return. It's as close as you get to, certainty so far as seeing out into the future. So keep it in mind. And here we are. We closed above the 200-day moving average also yesterday. There's two bullish feats of strength yesterday: the breadth, as well as getting above the 200-day moving average. And what I've been talking about in the trading room today was, this is typically, and that was a close above, not just touching it like we did in August, because we did intraday in August, but we actually closed above it. The only caveat here that I would, so far as a cautionary near term, is that the slope of the 200-day moving average, continuing downward, made this easier. Because this was up here around 4,300, and yesterday it was 4,050 to get above the 200-day moving average. So it was easier to get above that. What I would really want to see, and don't get me wrong, in my opinion, this is still a bullish signal going out 6 and 12 months historically, and we'll get to that data. But what I'd like to see is 50% of the decline retraced. 50% of the decline from the beginning of the year, I want to see that retraced. And in order to do that, we got to get to the 4190s in the S&P 500. So I think if you get above the 200-day moving average on the close, like we just did, with strong breadth, which we just did, and then move on to retrace 50% of the decline, I think the market is telling you, no. Media, you media elite folks, you CNBC and Bloomberg folks, you're going to talk to your blue in the face, but the money is telling us, as you said earlier, the sophisticated investors, the institutions are telling us they don't see a recession, or they don't see something severe going out into 2023. And you can probably get more aggressive at that time. Just my opinion. So again, closed yesterday above the 200-day moving average.
Williams seemed to just blow off any notion of a recession.
Did
you notice that?
Fed President Williams?
Yeah.
No, I didn't. I know he was speaking today. I didn't get to view all of his comments.
Yeah, that's why he was saying, "Oh, we're going to have to keep these rates high for a long time," because he thinks the economy is fine.
But yeah, I mean, most of them are saying that we have a strong economy because they have all reiterated higher for longer. And that demands context. It demands an understanding that, first of all, when they say higher rates, that's what they mean. Higher Fed fund rate. That's not necessarily yields. Yields, especially at the long end of the curve, the 10-year, the 20-year, the 30-year. That's the end of the curve that is pricing in the strength or weakness of the economy. And so that's what I would key off of there. That's where I would go so far as, what is the bond market telling me the probabilities of a recession are? And the fact that we have moved well off of the high, I think we got to 4.3% on the 10-year. And now today, I think we got down below 3.6. There we are. 3.5%. So we've lost 75 basis points from the high on the 10-year yield. So it's moved on. It's moved on from pricing in the inflation to pricing in the economy, the strength or the weakness of the economy. I think this move in the 10-year, 75 basis point, is simply that initial, you hit the ceiling, and now everybody sees equities and bonds as cheap. So they've been buying both, like crazy. The 60-40 portfolio has had its worst year since the 1970s and 1930s. Now everybody's buying that value. They see value in bonds or treasuries. They see value in stocks. But I would say, come mid-December and after the next FOMC meeting, I think that's when you're going to have a clearer picture from the bond market what it thinks about the economy going into 2023. So long end of the treasury curve is where you want to look for those types of signals, in my opinion. And again, when they say higher for longer, we're still, based on the last 12 years or since the great financial crisis, 4.75% on the Fed fund rate is high. But before that, we were talking about what, sevens and eights, going back into history for like inflationary periods, the 1980s and the 1970s. Folks, the Fed fund rate got up to 20% at one point. And in 1982 is when the Fed kind of broke, Paul Volcker broke inflation's back, in 1982. But the Fed fund rate was still, I think, by the end of the year, like 5%. The 10-year yield averaged 5% through the 1980s. Well, we've got a 10-year yield right now at 3.5%. So I think we got to put it all into perspective when we hear the Fed saying higher for longer. But is higher just 4.75%, 4.5%, maybe 5%? That doesn't tell you what the 10-year yield is going to be. And that's where the focus needs to be.
And those really low Fed rates were a result of us getting absolutely crushed in 2008.
Yeah.
They just kept having to bring it down and bring it down.
Yeah, and that was a hopefully once in a generational. We've never been through something like this. The actual financial system may completely collapse. Necessity of policy, taking it to zero and doing quantitative easing. Like, that was hopefully a once in a generational situation.
But my greater point was if the Fed says, okay, we're going to stay at whatever 4.95 for a year, I'm like, okay, I'm good.
Yeah, and I think the market would be fine with that. That's not detrimental to the market.
Yeah.
So yeah, absolutely. All right, we closed above the 200-day moving average for the first time in actually more than 160 days. And this chart here tells you all of the times since 1953 that the S&P 500 was below the 200-day moving average for more than 143 days. These are all the occurrences. I think that's 12 occurrences. And here, when finally the S&P closes above the 200-day moving average like it did yesterday, the average 6-month return after it closes above the 200-day moving average, after being below it for at least 143 days, the median return 15%, average return 11%. 12 months later, almost 19% and almost 20% median return. The best part of this is got a good sample size here. The positivity rate is 92% for both 6 and 12 months. I want to know, well, which is the year that this didn't work out? And here it is, 2002. That was the only year it didn't work out. So, to your point earlier, getting above that 200-day moving average, whether sloping down or curled up or flattening, historically doesn't matter, because it's typically a bullish signal for longer term returns. Intermediate, not that great. 1 month return, you got some negative signals here telling you there's probably a good deal of consolidation going on. The 1 month is it's still strong, 75% positivity rate. 3-month return, 75% positivity rate. So, the market's not lying to people. People always, when they look at these studies, they're like, I don't know if I believe that. What about this in the economy? The market is the market actually is a forward indicator. It's a leading indicator. It's in the leading economic index. The actual S&P 500 is in the leading economic index. It's a leading indicator. It's a forward pricing discounting mechanism. So whenever people give the pushback about, yeah, but what if in the future the economy does this or that? What do you think the 28% decline from peak to trough this year was all about? That's my pushback there. So only one time in 2002. And when you think about it, right, because we had to, I mean, you had a black swan event. We probably would have started the recovery from the dot-com era in 2002 if it wasn't for September 9/11, which happened in 2001. So that happened late in the year 2001. And so you had that spill into 2002. It took that kind of anomaly to drive a 3-year market decline. So, you know, I get it. I get it when it comes to that particular. And people, you know, speaking of 2000 to 2002 or 2007 to 2008, you know, this time is different. Getting above, closing above the 200-day moving average, you know, here was basically the same time frame in July. We tried to get above it here and couldn't. But here in 2007, 2008, we never got above it. We did not get above the 200-day moving average in 2008. And here in 2002, happened very early in the year, but we just fell over and it never got back above it. So we have a different formation going on here now. This is from Ryan Dietrich. This is a bear market rally, they say. The S&P 500 is up 13.8% in 2 months. That type of move isn't what you see in a bear market. It's true. Usually bear market rallies are quick. They happen in weeks, not months. The past 13 times, going back to 1950, it gained 13% over 2 months. It was higher a year later, 12 times, and up 20.7% on average. Now, I wanted to take that further. Steve Depp, he created what, you know, his own breadth thrust signal that distinguishes between bear market rallies and a new bull market. He calls it the 2 and 10 thrust. And so here's how he defines it. The study here from Steve Depp recognizes a 2-month, that's the 2 part, the 2-month 10% or greater advance in the S&P 500. So over a 2-month period, S&P 500 rallies 10% or greater. Every time that's happened, and again, it's a good sample size, just recorded here November 22nd, right? Because we just finished November. The rally started in October after, you know, that CPI print on October 13th. So after 2 months, 10% or greater rally. So these are all of the occurrences. And as you can see, 6 months later, the market has never, if it's in white, that means it's positive. 6 months later, after the signal, the market has always been positive. 8 months later, the market is always positive. 12 months later, the market is always positive. 100%, 100%, 100%. Even, you know, some of the other short, you know, shorter time frames, 1 month, there's a lot of white on the screen. The worst is the 1 month forward return. That's the worst at 72%. There is something different about this rally compared to whether it was the March rally or the June to August rally. There's something different here that has satisfied, you know, this particular study, and it tells us going forward, you know, hey, maybe we do get that nasty fall in January, February, but based on this technical setup and the bullish feats of accomplishment here during this rally, that's where you want to be buying, regardless of the headlines. That's where you want to be buying. One more from Ryan Dietrich, because this also just happened. Back-to-back 5% months have bulls smiling, as he titles it. 6-month returns only once. That you have to go all the way back to 1986. 6 months later, but 92% and 100% of the time, 12 months later, the market is higher. And these were all, you know, the precedents, November. There's 2009. You know, when you've had that 5% back-to-back months, usually the bottom is already in. That's what's being signified here. The bottom is in. Every one of these dates, the bottom in the market was already in. And it makes me think about what just happened in China, right? Nobody's talking about China being a bear market rally. That's 27%. That's just not how bear market rallies work. And these particular examples, the 2 and 10 breadth thrust or the 5% back-to-back month gains, that's just not typical of bear markets. So we're in the sweet spot here. The sweet spot is playing out perfectly. The seasonality in the market, otherwise I like to call it the scheduled fund flows. They're working. We got some good data here from Bank of America the day before Thanksgiving to December 31st. You know, the percentage of the time the market is positive, 71% of the time, so on and so forth. And the other thing we can't forget is we're in the toy barometer period. For those of you not familiar, just tuning in, the toy barometer created by Wayne Whaley, one of the most famous quants of all time. It starts on November 19th and goes to January 19th of the new year. It's called toy because it's the turn of the year. And it just so happens to also be around the gift-giving holiday. So it's called the toy barometer. And if we gain greater than 3% from November 19th to January 19th of the new year, it's a bullish signal that has only failed twice in its history, and that was 1987. We all know why that happened, because of Black Monday, and 2008 and 18. Those are the only 2 times. It's fired bullish 36 times since 1950. It's only failed twice. Average return, if it does fire bullish, is 16% forward 12-month returns. So just to reiterate that. And when we've had a bear market, which we have had in a midterm year, every single time that's happened, the next year has been positive for the S&P 500. Every single time we've had a negative return or a bear market in a midterm year, market has been higher the following year. And the average return is 28%. So you can't dismiss all of this quantitative data. Like it's hard to dismiss. Okay, so we'll segue here really quickly because we have talked a lot about the Fed. We've caught up on all of our quantitative data and where we are in the market. Going back to the Fed and going back to JP Morgan, which came out with the JP Morgan and Marko Kolanovic are rarely, bearish, but I think they came to a point, Brad, this year where it's like nothing we've been bullish about or positive about came to fruition. And now, even without a recession, with earnings still growing this year, I think they're of the opinion that there's an inevitability of a recession. And it is highly probable that we have an earnings recession next year. So they're just kind of throwing in the near-term towel. And basically, their recent notes have said, and I believe I have the notes here for everybody right here. Our view on risk markets in 2023 consists of 2 periods: market turmoil and economic decline that will force interest rate cuts and subsequent economic and asset recovery. So we got to get worse before we recover is basically how they see it. It's hard to give a precise answer on those 2 questions, but we believe that 1, previous lows in the equity markets are likely to be retested, as there may be a significant decline in corporate earnings at a time of higher interest rates. And 2, we are inclined to think that this market decline could happen between now and the end of the first quarter 2023. Indeed, one can imagine market turmoil as soon as at the end of this year, similar to 2018 episode of quantitative tightening. So, they basically have a downside sentiment here through the first quarter of the new year. which is what Morgan Stanley has, UBS, Deutsche Bank, and all the notes are here. Morgan Stanley, Bank of America, kind of the same thing. You know, we need to price in the earnings recession, and I get that, but I don't know that the market hasn't done that already. And if it's not going to coincide with an economic recession, we just don't know that it's going to be a double-digit earnings decline. And usually the market does not, fall apart unless it's a double-digit earnings decline. And in all of them, here's the other thing that's kind of interesting. All of them believe that revenue is going to grow 3 to 5% next year. It's hard in that environment to have a double-digit earnings decline, in my opinion. Do I think that companies are going to sandbag, full year guidance? I would. I would if I was an S&P 500 company. I would. It gives you an easy way to outperform and overachieve the rest of the year. I mean, you already see the negative sentiment there. It's kind of like the market has given a free pass for Jerome Powell to raise 50 basis points. Why wouldn't you take that? I think that's the way that, S&P 500 companies, by and large, believe as well. The market's giving us a pass.
Seth, here's the flip side of those rather negative projections on what might happen in the early part of the year or even the end of this year. How much of this, look at these big growth stocks, how beaten up they are.
Right.
Are investors just going to say, okay, we get it, but we're moving forward. We're going to look at what's happening in the second quarter. I mean, just ask yourself, can Amazon go to 70?
Yeah, exactly. I'm in the same camp as you. It's a risk. It's a huge risk to be bearish after all of the headwinds have basically been dealt with here in 2022.
Yeah.
Usually
so just stay invested. Keep plenty of cash. In fact, toward the end of the year, raise a little cash. And just do what you always do. And I think it's going to be pretty good next year. If you think about it, if we go through next year with kind of fits and starts, we're up, we're down, we're up, we're down. At the end of the year, we're up barely at all or even flat, which I think we're going to do better than that. Finom investors will make money in a flat year.
Oh yeah, we've always done well. I'll give my projections, how I kind of am chronologically looking at the market and its performance for next year. Officially, I believe that we're going to have a turbulent first quarter around that earnings season, which starts, I believe, in February. But I think any consolidation, let's say we end this year 4,000 just for round number sakes, and I don't know that's going to be the case or not. We might end higher or 100 or so points lower. But I'm saying 4,000 just to keep a round number here. I think we could drop as low as maybe, I don't think 3,500 is going to be the number. I think 3,600 to 3,700 is going to be the number, because investors are going to rationalize lower yields, higher equity risk premium, and unless we have something that proves an additional shock to the economy. Because think about, a lot of our weakness is predicated on weakness overseas. Our domestic economy is clearly the strongest in the world. So this is coming from overseas. So we need to see something get that much worse in Europe and the Asia Pacific. And the reality is the headwinds that they have this year are likely to turn into tailwinds next year. They're jumping over low bars in 2023. So they're going to actually facilitate a tailwind for our markets in 2023. But I could envision 36 to 3,700 on the downside in Q1 of next year. I'm not banking on it. I just have cash to deal with that. I do think that if that takes place, we recover quickly to around 3,900 by May, June. And then I think we actually start our upside progression into the end of the year that sees us anywhere between 44 to 4,600 on the S&P 500, because by mid-year, if things are looking flattish, then more than likely we start pricing in the recovery and the earnings growth for 2024. And I could envision if let's say we're $200 in earnings for 2023, I think the earnings rebound is a good 15 to 20%. So we're talking about $240+ in earnings for 2024. The market's going to start pricing that by mid-year next year.
Mhm.
So I'm thinking 44 to 4,600 by the end of next year.
Just for fun, Seth, I think about this almost every day, and I bet you do too. If next year is a pretty good year, anywhere near the area you're projecting, where is TQQ going?
I would see that around. Well, that, I mean, if growth would, in my opinion, be the outperformer because it was such an underperformer this year, and that's just kind of the mean reversion way the market works, or market symmetry, if you will. So I'm seeing that probably 55s to 60s by the end of the year, and it'll be a tight race between the S&P 5, between small caps and the NASDAQ. I think it'll be a tight race, but I think those are your outperformers.
Yeah, it topped out at what, 75-ish?
On a reverse split basis, around 75 to 80. Yeah.
Yeah.
So yeah, it wouldn't get back to even, and that's 4,400 to 4,600 on the S&P. Doesn't get the S&P back to even, but you're pretty close, and you're setting up, possibly a 2024 that gets you back to all-time highs in the markets. And again, this is all predicated upon we can't have another macroeconomic shock. And that's the other, nobody's counting on any kind of a ceasefire or some kind of peace treaty in Ukraine-Russia war. Nobody's baking. I haven't seen a single analyst report conceding to that probability, or even putting that in their overall macro geopolitical analytics. And I think that has reasonable probability. I don't know that Putin can sustain another 12 months of this in the Ukraine. It just seems untenable, for that to materialize. So, that could be a huge white swan, if you will, for 2023.
Yeah. Yeah,
I hope
could
it
be.
happens. I pray it happens pretty much every night.
Well, the headlines you're seeing on Putin seem to indicate he has little, if any, support.
Right. Yep. And the more attrition of, I just hate to talk about it, but the more attrition of their troops, it just, again, it becomes an untenable situation where he manages to broker his way out of it. It doesn't make the situation on the ground in Ukraine better overnight, but it does take it takes two huge geopolitical risks for markets off of the table. One is the obvious, the whole oil, and energy situation for the world. And two, what signal do you think this sends to Xi Jinping when it comes to the potential, Taiwan conflict and recapturing of Taiwan? I think he, not that this was ever going to be an imminent, political conquest for him, but I think it very much detracts from his, whole agenda. and you remove that from the geopolitical situation, again, I think, markets start really gaining, this energy when they remove these potential black swans.
Yeah, I really do think that what's happening in Ukraine took Taiwan off the table.
Yeah.
It's just not going to happen.
So bad. Yeah, it's like we really, and this is the whole thing. I forget who said it, but you can't win a war in somebody else's country, because as long as one person is still standing,
Right.
you lose. You lose. That's how it was, unfortunately. Vietnam, and we weren't. What are you going to do unless you're going to occupy and overthrow the government? Come on. So we'll wrap things up here. This has been great. I know we're extending this week's SOTM. I do want to reiterate, I will be on vacation through December. We will still have our weekly state of the markets. We will still have our official trade alerts and investment ideas, as we always do. But this year we've been talking so much about the headwinds in our trading room and in our weekly research reports. I have a close relationship with the team at Fundstrat, with the Lighthole Group, with many of these institutions. One of the most recent reports, and I talked to Christopher Robb. He's the vice president at Fundstrat. We have these conversations over Twitter and whatnot. And so he knows that all this year I've been emphasizing, when you have this many headwinds, you're setting a very low bar, and they almost automatically becomes tailwinds for the next year. And in the most recent report that they issued, they enumerated the headwinds for 2022, and look at the verbiage is exactly mine, which is becoming tailwinds starting December 22 through 2023. They have 11 headwinds enumerated here. I guess it just goes to show you, in my opinion, great minds think alike, but it's, market experience. You've gone through these bad times in markets, in the economy, this uncertainty, if you will, even these, hiking cycles. And a lot of folks have been through it in 2018. They're always difficult periods, but those headwinds usually result, as you are projecting for next year, they usually turn out much better the next year, because they're now tailwinds. You set such low bars of performance, whether it's economic, whether it's policy, whether it's S&P 500, the performance levels are so low, you can almost do nothing but jump over that low bar. Again, more notes here from other analysts. Ed Jardini, he believes that the bottom is in. We believe market bottom was 35.77, and look for a retest of 43.05, before ever, getting material consolidation. He's looking for a retest of the closing high from August. One of the things he's stressing is what we talked about just a minute ago. There's no real credit crisis potential. There's no real credit crisis potential. The most severe U.S. recessions have had aggravating factors that do not appear to be present today. We just don't have excess leverage and things of that nature. This is from Deutsche Bank, U.S. credit recession indicator. U.S. recession still less likely through Q2 of 2023, because we just don't have the credit conditions that, I guess you could say, accelerate the probability of a recession.
Yeah, and here's the problem, Seth. If you get that far into the year without a recession,
then we're talking about elections, right? We're talking about, and then you get fiscal policy benefits.
That's why I'm with you. I mean, could there be a brief blip of a technical recession? Well, maybe, but even that's just hard to see right now.
I wanted to ask you, I wanted to get your opinion, because you were a sociology professor, collegiate. The labor market, we've got all these jobs. We still have a very low, although it's trending up a little bit, we have a very low unemployment rate. what's your sentiment? What's your, thoughts about the unemployment rate, the labor participation maybe as a factor, and what do you see happening possibly next year?
Going back to where I was a student of sociology, which is a long time ago, we were predicting where we are now. And that is, these baby boomers are going to start retiring.
Right.
And when they do, that's going to turn the whole labor thing upside down. Now, gosh, and labor can almost call its own shots right now. Everything has just flipped. And then you've got this interesting mix of, you've got COVID, you've got, we went through an extended period of time where labor was not treated very well because labor was plentiful. And so,
when you say not treated well, what do you mean by not treated well?
Depressed wages,
okay.
not as much the wages, but just how you're treated as an employee.
Yeah, sure.
Because they had the upper hand.
Yeah.
Well, so you've got us baby boomers, and I was born in the middle of it, so we've still got quite a bit to work through. Some have just said to hell with it.
Yeah, after COVID. Yeah, I'm hearing that.
I didn't have to retire when I did, but there wasn't any reason to work any longer. You've got things going on, and sociology is one of the worst fields to teach in right now because you can't say race in the classroom. How do you teach sociology without talking about prejudice and discrimination and all these things that we all know are still there?
Yeah.
Kind of like what's the line I'm hearing in the media? Don't say gay. Yeah. It's politics, and everybody knows what it is. If you can score political points and get your base out to vote by saying certain things, well, they're going to do it.
Right.
But it's not helpful. But what I was, and we think you can't see these numbers, but we think there are a lot of entrepreneurs out there that appear not to be in the workforce, but they are. They have their little businesses at home and so forth. Right. And those numbers are hard to find.
Yeah, the gig economy type workers, and
I think there's more and more
self-employed LLCs. Yeah.
I mean, who wouldn't want to work for themselves?
Right.
If they could.
Right. Yep.
Like you and I do. It's been the most wonderful time of my life.
Yeah. Congratulations on the retirement.
But you're not really retired. My wife's always telling people that I'm busier than I was when I was teaching.
Well, it's a fun busy though, as opposed to a work, punching a clock type of busy, I think. So absolutely. Yeah. All right. Well, thank you again for joining me, Brad, and all the
it was fun
dialogue. I hope all of our Finom Group members and YouTube audience found this interesting. Come back next week, Thursday, folks, and we'll see where the market is. If you're not subscribed to phenomgroup.com, you don't get our State of the Market video on Thursday afternoons in real time. So subscribe today. And let's hope for a good year-end rally. A Santa Claus shows up, hopefully this year. And we'll be back next Thursday. Take care, everybody.
See ya.